Hi, this is Rachel Marshall, and today I'm going to talk with you about privatized banking and how the wealthy are using this strategy to boost their investment returns and maximize opportunities. The wealthy know how to get money working for them, and that is really one of the sources of their wealth. So I want to show you how to use that today, how to sharpen the saw and really fine-tune what you are already doing in your financial life so that you can accelerate wealth and achieve financial freedom sooner. Now, whether you're looking to deploy capital into opportunities like real estate, or maybe you're investing back into your own business, or maybe you're investing in someone else's startup business, or acquiring an existing business to be able to expand your own footprint, you need capital. And needing capital doesn't necessarily tell us how to deploy it. We can either have our own capital or someone else's. But either way, we want to be in a position that we can increase and maximize our returns and minimize our costs. So this is really the need for banking. To be able to have access to capital, not necessarily our own, but have access to capital and be able to use, deploy, or leverage that capital to obtain opportunities. Now, the question is, in today's environment, where do we store that liquid capital, or dry powder, if you will? The problem with holding your own capital is that you get almost no rate of return on that money. And we know that debt is cheap. So secondly, many people have a limited idea of the long-term impacts of their financial choices, and that can lead us to making decisions to shrink costs that might end up expanding and ballooning our opportunity costs when we look at the big picture. So you need a fundamental working knowledge of 3 very fundamental financial concepts in order to make sure that you win every time. The wealthy understand that all capital has a cost, and they use leverage to make sure that they boost their returns and increase capital in their control. Today, we're going to talk about your need for financing in today's economy in a way that gives you the greatest control, efficiency, and utilization of your own money. I'm going to show you how to use specially designed life insurance to give you one of the best tools of the wealthy that's been used for over 150 years to store liquid capital, to be able to allow them the benefits of safety, liquidity, and growth on their money, borrow against their capital, and use other people's money. Here's what it allows you to do. When you use privatized banking with specially designed life insurance, you are able to maximize the returns on your investments, maximize the cash flow in your business, maximize your access to capital, maximize your emergency and opportunity reserves, while at the same time also shrinking your tax liability, shrinking your costs, your opportunity costs, and your risk, all at the same time, best deploying capital for cash flowing investments. Sounds like a complete winning strategy. So let's show you how we do that. Now, I also understand that as a business owner, you're busy. You want to be in an environment where you're either moving your business forward, or you know that what you're learning is directly applicable to your business and accelerating your success. So I believe in keeping money fun, simple, and doable. At the Money Advantage, we believe in empowering you and helping you succeed so that you can create a life and business you love now, not having to wait till sometime in the future to hopefully start enjoying life. We want to get your money doing the most for you. So let's dig in. This is the cash flow quadrant developed by Robert Kiyosaki when he created Rich Dad Poor Dad in the Cash Flow Quadrant book. You may be familiar with this if you are a fan of his work like I am. So on the left-hand side, we have E for employee, S for self-employed. On the right, we have B for business owner and I for investor. What the premise of this quadrant is that we want to move from the left side, where we are working for money, to the right side, where we get money working for us. Now, I do want to distinguish really quickly the difference between self-employed and a business owner, because many times as we first get into business, we are grinding and we're wearing all the hats. And in that position, that's actually self-employed. we might be on the way towards business ownership, but when we're still working in our business and the business is dependent on us, that is a position of being self-employed. We want to ultimately move over to being a business owner where the business can continue to operate whether or not we are there and be able to bring in income. Investor, as being an investor, is when you have your assets producing income for you. Now, Robert Kiyosaki's definition of financial freedom is that when you have passive income, which is income from your assets, your businesses and investments, producing enough cash flow that it accommodates your monthly expenses, you're financially free. Now, if you had businesses and properties and real estate that is paying for your monthly expenses, you could then be financially free today and continue to produce income in your life on top of that, and that would be accelerating your lifestyle. We want to get you there as quickly as possible. These are some basic financial statements that you will see in your life. They're kind of behind the scenes, and you may never have thought of your money this way. This is in your business life and your personal financial life. Your income statement is income and expenses. This is money coming in and money going out. We have then our balance sheet, which is assets and liabilities, what we own on asset side and what we owe on the liability side. Here's what most of the typical way of dealing with money looks like. Money flows in from income, usually from a job, goes straight to liabilities, things like owning a home and a car and student loans. These are all liabilities. Those all have expenses associated with them. And so our income comes in, flows through liabilities, we pay the expenses of those liabilities, and then most of that money is just simply consumed and gone forever. Here's what we want our money to look like instead. Here's what the wealthy are doing. We want our assets to produce our income. This is the goal and the position that we all want to obtain so that we can get in that position of financial freedom. How do we do that? And we're going to look at the personal economic model. Again, this applies in your personal life or your business. What we're seeing is you have typically money coming in through earned income, flowing in through monthly cash flow, taxes are taken out, and the rest usually goes out through your current lifestyle. Now, if you pump some of that money up into the future lifestyle, into some type of investments and savings, then you have assets. So these two upper tanks here are your assets. If those assets are producing income for you, then your income's not just coming from earned income from a job, but you actually have investments or savings that's producing additional income for you. And that's the objective and the goal that we want to be. I want to distinguish something very important as well. Many times the typical way of thinking about money is accumulation based. It means let me work during my working years, pile up money in this investment tank, have a little bit of savings here, and then when I retire and I stop the income coming in from earned income, that is no longer, I want to be able to live off the interest from my investments without depleting them. This doesn't usually work in many cases for many reasons. One of those is that it's challenging to get enough money in that investment tank in order to actually be large enough to live off the interest. Another reason is risk of loss. If we lose money in our investments because we didn't have control, then we have depleted our capital. We also have to look at the challenge of taxation, not knowing what future taxes will be when we go to take money out of those investments. And also just the rate of return. We don't know what that will look like in the future. Inflation is another concern with this model and storing away for the future because we don't know if our dollars will actually have enough purchasing power, even if we have the right amount of cash flow in the future that we planned for. And then we also have a longevity risk when you potentially live longer than your financial projections and there may not be capital left. So those are some of the concerns of the typical accumulation-based way of thinking. Instead, if we focus on cash flow and we have cash flow coming from our assets, we can now accomplish financial freedom today. And as we continue to build more and more cash flow from more and more assets, you're in a position where you're just continually expanding the amount of cash flow you're living on, which is ultimately the goal of the accumulation-based model, to have cash flow in the future. I say, why not go ahead and start making cash flow right now so that you can start that journey of financial freedom and be able to really create that life you love today. So that's what this conversation is all about. Opportunity seeks liquidity. What that means is that opportunities are all around us. They're looking for the person with the right amount of capital to deploy in those opportunities. Now, here's one of my favorite quotes from Kim Butler, and this is from a blog post called The Surprising Business Financing Secret of Top Entrepreneurs. She says, "What makes a business succeed? As a general rule, capital comes in handy. And whether lack of cash is a symptom or cause of a failing business, it certainly can be both, undercapitalization brings down more businesses than anything else." So if we don't want to be undercapitalized, we want to be sufficiently capitalized. And that means we want to have sufficient capital. So how do we keep capital so that we can be in control, so that we can keep our business thriving and growing, and make sure that we are riding this wave of cash flow to our financial future and ensuring we reach economic independence? So when we look at capital, we need to ask the question, where is this capital going to come from? The first foundational concept we want to discuss is that debt is negative equity. Now, this is a surprising definition to many people who fear debt and want to do everything they can to get out of debt and pay it off as quickly as possible. And I want to have the fear removed so that we can really see clearly and objectively what debt is, and we can accomplish, or we can tackle it in the right way that's actually healthy for you instead of limiting. So when we look at our financial statements that we looked at a moment ago, the income statement is where cash flow sits. So cash flow is income minus expenses. Income is the money you have coming in, expenses is the money going out. The difference between the two is cash flow. In order to increase cash flow, we can either increase our income or we can decrease expenses. Either way, we bridge that gap and we increase the gap between income and expenses. Now, net worth sits on our balance sheet. This is the difference between assets, what we own, and liabilities, what we owe. So assets minus liabilities equals net worth. What this means is that if we own more than we owe, we're in a positive equity position. That's called equity. If we owe more than we own, then we're in a negative equity or negative net worth or debt position. So here's what debt means. Debt means negative net worth or negative equity. So it doesn't mean you have a liability. Just because you have a liability does not mean you are in debt. If you have a liability or liabilities that total a greater amount than your assets are worth, then you're in debt. Now here's how liabilities impact your income statement and your cash flow, and where most of the pain of having debt really is for most people. When you have the liability, it often has a fixed expense associated with that. So if you have a car payment, that's $300 a month, and you have a auto or you have a student loan payment, that's another $150 a month, and you have your mortgage and maybe that's $1,500 a month. Those are your expenses associated with that liability. The expense goes up on your income statement and shrinks your cash flow, because the more expenses you have, the less cash flow. So if you could keep your liability and you were in a position that was actually positive equity and you had no payment on that liability, no expense or very minimal expense, I personally would feel comfortable keeping that liability forever, because it wouldn't really be crimping my cash flow, which is the main focus of how I accomplish financial freedom. So we're really focusing on the income statement side. We want to maximize the cash flow by shrinking expenses and increasing income. And we want to make sure that we keep debt in the proper perspective. We're going to come back to that later, because again, the wealthy use leverage, and I want to show you how to do that effectively. But first, we have to remove the fear and the stigma surrounding having a loan, because that does not mean you're in debt. Foundational concept 2 is that you are always paying interest. Now, this is a new concept for many people, because we can understand that when I finance something or I borrow money, I'm paying interest to the person who owned the capital. However, when I pay cash, I also am financing and I'm paying interest because I'm giving up the ability to earn interest. Now, let me help you walk through this mentally and visually so that you can really grab onto these concepts. We want to talk about how to utilize your money most efficiently. Now, the most common options people use for that is either 1, to finance, or 2, to pay cash. Let's look at the difference. When you finance, You pay interest to someone else to use their money. You did not have your own capital, so you financed. So many people turn to paying cash as a result, saying, I don't want to pay interest. I don't want to be in debt. I don't want to pay interest. Therefore, I'm going to pay cash. When you do that, you do give up the ability to earn interest in the future if your money is no longer in your control. So when it comes to the utilization of your money, you are financing everything you buy. This leads us to a concept called opportunity cost. And really, that is a simple concept that really means if you gave up $1 today, you did not only give up the dollar, but what it had the ability to earn for you had you kept it. And so really we want to take opportunity cost into consideration and measure it effectively to make sure that we really are making the best long-term choices. Here's what happens if you finance. Say this black line at 0 is 0 equity. If you were going to finance a recurring purchase, say it's a car every 5 years, and you had no capital of your own, what would happen is that you would go negative with your equity as you take out that loan, and then you would pay it off. And once you've paid off that loan, you would be back at 0 equity. Here's what it looks like. You buy the vehicle, let's say, and go into debt at that point because you have negative equity. That's why we're dropping below the 0 line. That's negative equity. Then we pay it off. We stair step back up to 0. And then at that point, we're financing another car. And then we're stair stepping back up to 0 as we pay off the loan. In another visual, here's how that looks. So remember, we said these are your assets here, what's ever in these 2 tanks, investments and savings. If we don't have anything in those tanks and we go to borrow money, we are now in a true liability or debt position. That's why this is showing as red over here in the borrowed funds tank. This is that we financed and now we're paying off that loan. And then 5 years later, we're financing again. We're paying off the loan. So our net worth is spiraling back and forth between negative and 0, negative and 0. We're never moving ahead. So if that's not the best solution, then how does paying cash stack up against that? Because again, this is the typical alternative to financing because people want to avoid that payment of interest. So the person who saves up their capital and then pays cash for that same car, then has built up their capital in their asset tank, and then they have drained the capital. Then they stair step and build that back up, and then they drain it. Again, they're never moving past 0. So they're really not any better off than the person who just financed and took out loans and went into debt. How does this look on the tank model? So as opposed to, remember, the person in debt just borrowed money and paid it off. Well, here we have the saver saving money and paying cash and draining the tank. Saving money and draining the tank. They're not any better off. I want to show you something really profound, and this is the true cost of paying cash. Let's say that you were saving $10,000 every single year and putting that aside into an environment that you knew you were going to earn every single year 5% growth on that money. We're putting our capital in a position of compound interest growth. This cannot be something that's open to risk of loss because you're not able to earn compound interest in that environment. This has to be guaranteed, consistent, year in and year out growth. Now, if we were to do that, see these green lines here, we would end up after 30 years with $707,608. This is just simply the miracle of compound interest at work right in front of our eyes. The problem is that when we pay cash for something, we've drained the tank, and then we need to rebuild up our capital reserves. When we do that, we reset the compounding. So the compound interest we were obtaining on the capital we already had has to start back at 0. And that compound interest curve really is miraculous at the end, not at the beginning of the curve. And so as we reset here in year 5, and then again in year 10, and year 15, and so forth, we're coming back down to 0 and restarting the curve. The difference here, if we drain the tank 5 times and take 4 years to replenish each time we drain the tank, our difference is that at the end of 30 years, we now only have $142,068 to show for all of our work. Instead, we've actually depleted our long-term holdings by $565,540. So what we're saying is we want then to be an environment where we don't use up our money, we keep our money. But we want to not reset the compounding on our capital. We need to be able to have a way to not reset the compounding on our capital, but still be able to use our money to produce a return. So these are the two objectives that we're working to solve so that you can most effectively use your capital. Now, the problem also that this reveals is that there's no really good way to store cash. I'm sure that you were a little incredulous when I showed the 5% rate of return. No one's earning 5% on any cash anywhere that I'm aware of right now in most of the standard environments. So let's take a look at that. If you go out to the 10-year US Treasury note, we used to, in the 70s and 80s, have a much higher rate of return. But now we've fallen to about 2.33% today. If we move into looking at CDs, we have a 3-month CD rate today of about 0.45 to 0.9%. That's less than 1% return on your capital. And you also have a penalty fee if you need to get out early, so it's not as liquid as you want it to be. Again, we want our money to be liquid. We also want it to be safe and not drop in value, and we want it to be growing at a rate of return that works for us. None of these environments are showing that to me. We also then know that you could go out to a money market account. Well, that's going to earn about 0.08% according to the FDIC right now. Or a savings account, which is even worse, at 0.06%, or maybe even 0.04, depending on where you go. So these are not a compelling way to be able to save cash and have capital in your control. So understandably, we've seen the personal savings rate then decline from the 70s to now. So it was about 15% to now about 5% today. We've also, because people are not valuing and holding capital, we've seen the use of debt skyrocket. And that has gone from the total public debt moving from about $500 billion to over $18 trillion in that same span of time. These are the problems associated with not having a place to store capital that's safe, liquid, and growing. This problem has also caused two other significant problems. One is that because there doesn't seem to be a good place to store capital that's safe, liquid, and growing in the safe tank, we see this movement over towards investing instead of saving. And people are not building a strong pool of liquid reserves in their control. They're saying, well, I need a higher rate of return. I'm going to go out to the stock market. Hopefully, I'm going to get something higher rate of return for my money. But as we see, there's not only the potential for a higher return, there's also the potential and risk of loss. That causes us to lose money another way, which is interest charges. When we don't have our own capital, we're dependent on financing as a means of making the purchase that we want to make. And because there's no capital, you have to pay to use someone else's. Now, the difference between unsecured and secured line of credit or loan is significant in terms of the amount of interest charged. And so you're paying additional financing costs because you don't have capital in your control. So if I could take you to a bank that had a 5% rate of return year in and year out, that was safe, liquid, and growing, how much of your liquid capital would you put there? So that world no longer exists, but at the same time, that doesn't mean we can't design our own. We have different mechanics, different process and systems, but we still utilize and store money in that same way. This leads us to foundational concept number 3, the bank wins. Model the bank. Let's talk about how the bank has become one of the most effective and profitable business models in the world. So here's the bank. The bank wants to get capital as often as possible, hold it as long as possible, give up as little as possible, and take as little risk as possible with that money. Now, those are the bank's rules. And frankly, we typically are told to operate with the exact opposite playbook. We give up as much cash as possible, as often as possible, take as much risk as possible, and get as little back as possible in the meantime, and just hang on for the journey and hope it all works out, stay in it for the long haul. But it's the bank side of the equation that always wins. So how exactly does the bank make money? Well, they first have deposits. And from that deposit, they're able to pay, say 1%, I'm going to be generous with the rate of return, the interest rate here, 1% to the depositor. Now that's an expense to the bank. They're then going to loan out that money and earn, say, 5% on their loans, and that's going to be income to the bank. So they have deposits, They have loans that they make and they get repayment of those loans. They're able to make new deposits with that money. So they're using what we call arbitrage or leverage, and they're able to earn more interest than they pay. Now they're still paying interest, right? They still have an expense to the depositor. So again, the bank recognizes that all capital has a cost, just like we do, but they're earning as well, and they're earning more than they pay. So $1 deposited, they pay you a penny, they loan it out at 5%. That is actually a 400% rate of return. They're taking 1 cent and turning that into 5 cents. Now, if you look at this with fractional reserve banking, the number actually increases because they're only required to hold 10% reserves or 10% capital in reserves and loan out 90% of the dollar that's deposited. So of the dollar that's deposited, that becomes the 10% reserves, and they're able to loan out $9 more. When you look at that, they're able to significantly use arbitrage and leverage to amplify their cash flow in returns. They also employ something called velocity of money. So the number of times they're able to turn this money around and through the system, the more effective it is for them. So if they're able to get a loan repaid quickly, they're able to loan that cash back out to somebody else. And the more times they can turn that, the more profit the bank makes. So if the bank earns 400% plus more because they value holding capital and reaping the rewards, why can't we do the same thing? They control capital, earn interest, use leverage, increase their cash flow, and use velocity of money. And we can use those exact same principles at work in our own financial life to reap the rewards the bank is able to have. So this brings us to another strategy of financing. Besides paying cash and taking out a loan, we can use a private reserve. What is a private reserve? Private reserve is maintaining your capital, earning uninterrupted compounding, borrowing from yourself, using your capital as collateral, paying yourself back with interest. So I want to show you how this works because I know that's a lot to wrap your mind around. So here's what it looks like to have wealth that you continue to maintain control of and never let go. Remember that uninterrupted compound interest curve we looked at earlier? This is what happens when you are able to reap the benefits in your own personal life of compound interest, never letting go of your capital. So then when you need to use capital, you borrow against your reserves, never depleting your capital. And by the time you have paid back that loan, your own capital has raised or has risen in terms of its value and is now beyond the level that it was at when you took out the loan to begin with. Let's look at this another way. Remember what we talked about before, that if you are using debt only and you're actually going into negative equity and you're financing with nothing that you own, no assets, you're just borrowing here and paying off and borrowing and paying off. It's different when you have capital in your control though. So let's say that you did have some money in your safe tank here. This is your collateral that you own. Now you're able to go to the bank and you're able to ask for a loan against your assets. And in this position, you're able to now get a secured loan. You're able to negotiate better rates, probably better terms in terms of the length of the payoff of the loan. Both of these things are going to put more capital back in your control each month, have a lower monthly expense, and increase your cash flow over having no collateral. So let's see what happens when we borrow now. We're in a collateral position as opposed to a debt position. So we borrow not the full capacity of our cash that we have. Now we still own more than we owe. This means we're in a positive equity position. We have used leverage, we've used a liability, and kept our own capital. And that put us in this powerful position because we're able to have negotiating power with the lender, and we're also able to increase our cash flow each month as opposed to if we did not have our own capital. So then we pay off this liability, and by the time that's paid off, this is continuing to grow in terms of the rate of interest. Then we're able to borrow again, and by the time we pay off, this will have increased because of the rate of return and the internal growth on that account. I want to show you this one more way. This is building up your own capital reserves here that has compound interest inside of that tank. Then you're able to go to the financing institution, perhaps a bank, perhaps somewhere else. You're able to take out a loan against your capital. So this is an amortizing loan typically. This is illustrating that it's to pay for an expense like a college or wedding, college education, wedding, or a car. And they put a lien against your capital that's being used as collateral. And then you would pay back with structured payments, fixed monthly payments. And once those are paid off, they would reduce and remove that lien from your capital. And so you're able to not only earn the compound interest, but you're able to reuse and recycle this private reserve, this tank of money that you have that's in your control on the left-hand side, where you never stop earning interest and you're able to use it using other people's money to finance your purchase. Now, I want to bring out something important as this relates to how people are using this. You may have heard there was an article that came out about Mark Zuckerberg. I think this was in 2012. It was a while back, but he took out a mortgage for a $6 million home. Now, at the time, his net worth was about $15.6 billion, and he could have easily paid cash for the house. But instead, he took out a loan. So why did he do that? He valued having capital that was in his control that he could use, not tying that up in an asset like a home, where if he wanted to get to that capital, he would have had to go to the bank, take out a home equity loan, qualify for that, have that hit his credit score. He wanted to be able to control that capital. So if a billionaire like Mark Zuckerberg, which now he's worth $55.5 million, to my knowledge still has that mortgage on his home. So if he values using a liability to finance, even if you have significant cash to pay cash for something, what can we learn from that? Let's keep our cash and finance. That's what the private reserve strategy allows you to do. Keep cash and finance, not either or.